Second, we talk about residency of the taxpayer. And thirdly, we look at, go to full screen. And third, we look at the same income cannot be taxed twice. Okay, we're going to talk about all these three items. So just hold your horses. Slide 9. We're talking about U.S. tax system. So anyone who's a U.S. citizen or a corporation, the U.S. citizen and resident. So if you're a U.S. citizen or a green card holder, or if you're in the United States for more than 182 days, then technically you are responsible for your tax on your worldwide income. Credit system is when you include the income, you also get credit for what you paid in India. So it's not double taxation. And finally, India has a tax treaty with the United States. So you get a little break on that. Okay, slide 10. We talk about personal services. So it depends where the services are performed. So if you perform the services in India, then India is going to tax it. If it's performed in the US, then US taxes it. Interest income, you get if you're a US bank, you get what is called a 1099 interest. And same thing with dividend, you get a 1099 dividend. If it's a US corporation, in foreign corporations, you don't get a statement, but you should report that income in the US return. And same thing with an Indian bank. So it depends on the residency of the payer. So if it is an Indian bank paying you, then it's Indian income. If the US bank paying you, then it's US income. Okay, capital gains, when you buy and sell assets. So if the assets are located in the US, then you talk about US income. But if it is a foreign, then it'll be foreign income. We'll talk about real estate in 1 minute. And rents, where is the property owned? So if the US property, then you'll pay US taxes. If it is a foreign property, you'll pay foreign taxes, but then you can get credit in the US for what you have there. The personal property, like a car and any major equipment, if you sell, then it's called, depends on the seller's tax your home. And if you're US, then it'll be US. And if it is foreign, then you're foreign. Pension, of course, is there if where are the services rendered. So if you receive a pension, I have a client who receives pension from a Indian railway. Now that is an Indian income, even though he receives it in India and then he is entitled to that income, but technically it's Indian income. Pension investment earnings, location of where the pension is. And then finally, sale of property. That's really important. Okay, if you sell US property, then you'll pay US taxes. Indian property, you'll pay Indian taxes. But you'll have to bring that gain and add it to the US return. And I'll show you how we can do that. Wealth transfer, we are on exit slide 13. Make a will, estate, gift tax. We can do all three of these, which very few CPA firms can do. And with states, we have lower, states might have lower thresholds. So we'll talk about that. So every year you can give your kid, each parent can give a kid $14,000 tax-free. And if it is husband and wife, then it becomes $28,000 per kid will be tax-free. If you're an estate, it's subject to 40% tax if you own more than 5,340,000 in what you call taxable estate. So let's say you are inherit Donald Trump's wealth of maybe 20 million. I just did an example. Then 10 million will be exempt because 5 million for the husband and 5 million for the wife. So 10.6 million is not taxable. Above that, it will be taxable. So any amount the husband doesn't use can be used by the wife, and the wife passes away before the husband, then the husband can use it. So technically 10.6680 not taxed. Above that, any estate will be taxed. A few things about US estate planning. I'm on slide 16. Accelerate deductions, defer income. That's a common tax planning tool. We always like to do that at year end. Review your portfolio. You're entitled to $3,000 worth of tax loss. So every year, if you have a loss, take it up to $3,000 of capital loss. Approve charities. Always make sure you got a deduction or the identification of the person you're paying that amount to. So an approved charity in the US has a EIN number. You should try to get that. Employee identification number. Max out your retirement accounts. That's a good planning. Optimize your refunds. If you're getting too big a refund or you're paying too much, then the tax planning is not accurate. Okay, all planning before year end. Have flexible spending accounts. Pay your state taxes, real estate taxes in December instead of Jan, so you get a deduction faster. And then finally, pay all estimates and make sure on December 15 that before Christmas that you're all set to pay your taxes. So if you pay 110% of last year's tax, then technically it's called safe harbor and you don't have to pay additional penalties. I'm going through these slides a little quick because it's been around. But after this tax year, after the election, lots of things are going to change. So I cannot predict the outcome, and it's going to be pretty difficult to predict what's happening. But no change is going to take place for this year. That is tax year 16. It'll all be in 17, if at all. Okay, so if you're married filing joint 300, you get a your highest rate is 39.6%. Plus, you have an additional Medicare tax, which is really, this is all based on Obamacare, we call it. Then your additional tax is 0.09 on all investment income and net investment income, 3.8%. So tax planning, move into an active business. That way you can reduce your passive income and increase your active income. Okay, this one, pay down your mortgage. Here's a good tax suggestion. So if you're high income earner, pay 2 extra payments, so you'll get higher interest deduction. And there's something called alternative minimum tax. They calculate tax 2 ways, and depending on the higher, you're going to pay that. Charitable contribution, I mentioned, always approve charities. Okay. Common mistakes people make, they don't avail of all the deduction. And not reporting foreign income, that is very dangerous, because if they do find you and if they do have information, then the penalties are very, very steep. Okay, inflating charitable contribution, non-cash, greater than $500, they need substantiation. And Schedule C, if you're an unincorporated business, they look for more scrutiny. Personal expenses charged to business, even not allowed, but I want to caution a lot of stuff they keep looking at. I'm on slide 22. FBAR reporting still available. So if you have foreign investments, foreign bank accounts, foreign shareholding in corporation entities, we'll talk about that in a minute. There's a form 8938. It's called specified foreign financial assets, and the threshold. So if you're married, it's above 150,000. You're single, it's a lower number. But you want to make sure you're complying with that, because here again, they tie the FBAR to these 8938s to see who's filing and who's not filing. So be careful with that. Now, if a U.S. person pays someone else, a foreign person, like a U.S. non-resident, then you have to withhold 30% on the top and then send it in. Okay, so here's a very, very good example. This is an important slide, slide 23. So let's say you earn interest income of 30,000 in India on fixed deposits, and you have dividends of another 10,000, so you have total Indian income of 40,000. India is going to tax you the 20% only on the 6,000. It'll be 6,000 tax, because they only charge you 20% on the interest income, and there's no tax on dividends. So that's your Indian tax liability. Now you want to take the U.S. side. So let's say you make 100,000 income, you add the Indian income, so your total global income is 140. Now, since you assume your tax is 28%, so you'll owe 39,200. But you will get credit for the 6,000 that you paid in India, so your net tax due to the U.S. is only 33,200. Okay, so you add the Indian income to come up with your global income, but you also deduct the tax that you paid in India. So that way you pay less to the U.S. government by this computation. So very important slide to work through. Okay, sale of Indian property. I get this question all the time. So you pay capital gains tax in India, and then you file an Indian income tax return. You have the option to defer the gains in India by investing in rural bonds, but in US it is still capital gains, so you still owe money in the US. Step 2, include the capital gains in the US return, and then you have foreign tax credit for the taxes paid in India. The good news, US and India has a similar tax rate of 20%. So whatever capital gains you pay in India, which I strongly recommend you pay Indian money so that your proceeds are less, then the same amount is reported on a US tax return and you'll be okay. So here's an example. So if you have a property you inherited, now we talk about inheritance. So you inherited a property in 1950. So your parent bought it for 10,000 and the parents passed away. On the date of that in 2011, the property is valued at fair market value is $1 million. Then someone turns around, the descendants turn around and sell the property in 2016. So they sold it for 1.2 million. So the gain, is only $200,000. You have to be very careful with this, because I've seen a lot of people make the mistake and not 1,990,000. So you might actually take this, actually this number is wrong. I think it should be, I did this in a hurry today. So it should be the 1.2 minus the $10,000. That would be your amount here. Not 199, it would be 1190. So need valuation on the date of death. Okay, that's important. So this 1 million, this basis is only 200,000. I want to correct this slide. So instead of capital gains, it'll be 1190, just as an FYI. Here's some tax planning on slide 26. You can defer some of the gains. So let's say a tenant pays you the money on December 31st of 14, but if they pay you in 15, then this will become part of 15 income and not 14 income. So I advise some of the clients, don't take the money December, take it in Jan, because in the Indian tax return, it'll be the same. But for the US tax return, this will be in 14 if you collect the money in December. It'll be a 15 item if you collect it in Jan. So big difference there. Okay, here are foreign tax forms. I think 90% of the people that I deal with have no idea this exists. 5471, if you're a director and you own more than 10% of a investment in a foreign corporation, you have to file this form. Foreign tax credits I've mentioned, you might be aware of that, 1116. PFIC 8621, that is passive foreign investment company. So if you invest in Birla Fund, and Birla has most of its assets, 50% and greater than 75% of their income is earned from passive activities, and they have more than 50% in the assets that generate that, and it's called a PFIC. So technically, you pay the highest rate of tax in foreign mutual funds, if that's the nature of investment. And FinCEN forms is FBAR forms. Now you have to file electronically. It's Form 1114. 3520 is a US tax form. Now, if you have gifts, inheritance, even from India or anywhere in the world, technically you can file this form, and then they keep track of when you sell these properties to inherit the basis. Slide 28, control foreign corporation. Like I said, it's called CFCs. If you have greater than 10% of the voting power or shares in a foreign company or an entity, then and you're a director of that corporation, then you have special reporting requirements. The form number is 5471. And there's a stiff penalty, $10,000 penalty every year if you don't report that income or loss. So they're getting strict, and if they find it, then you're in real trouble. And I did have a client who had not filed this for 10 years, and it was a $100,000 penalty, but I was able to convince them, and we filed for 10 years in a row. It was very complex, but we got it done. Otherwise, the penalty could have been pretty steep, but we are able to get out of it. But sometimes they're generous, sometimes they're not so generous. Next one is on slide 29. It's called BEPS, or dividend repatriation, base erosion, profit shifting. This is more complex. So moving profits, what Apple does and a lot of companies, they move profits from high taxing countries to low taxing countries. So Apple moves the profits from the US to Europe. Luxembourg is less tax, 4%, whereas US is 35%. And the second point is there's no tax on foreign earnings. So let's say US parent and an Indian subsidiary. So all the earnings that the Indian sub makes is not taxed in the US until the dividend is repatriated back to the US. So that's a major saving in tax. So if you do structure a transaction, you want to have a US company with a foreign sub Indian company, then all the earnings are not taxed till such time you bring the dividends back to the US. On slide 31, now we'll switch gears and talk about appropriate tax structure. I get literally hundreds of calls on this because no one knows how to set up a business in the US appropriately, depending on the type of business. So I'll give you a few examples. So Indian companies wanting to do business in the US or US companies wanting to do business in India, the tax structures become very important because it's efficiency. So here's an example. So if you're a US resident and I had a client who was a US resident who returned to India, took salary from an Indian company. So the rate was 30%, which was pretty high. So what we did is we convinced him to start a US company as a sales office. That's what he did, and pay the salary in the US. But you must have a tax home in India. So the tax efficiency, there's a section called foreign earned income. It's a form 2555. 100,000 of that income is exempt from US tax. So that's a big difference. And then finally, you can contribute to a retirement account up to 25% of that earned income. So you're actually paying tax. This is all tax-free, and this is also tax-free. So it really gives you a good vehicle for tax planning. Slide 33, what structure is appropriate? You need more scrutiny. You want to look at C corporation, Schedule C, it's on a 1040. So if you're an unincorporated business, you will file that form. The question becomes, you want an LLC or an S corp? It's called a pass-through entity. Okay, now ACA healthcare also, they're going to crack down real seriously, and if you don't carry healthcare, there's going to be serious penalties. I think it's up to $600 for each person who does not carry healthcare. Consider non-taxable. It's like a non-taxable benefit to employees, and estimated taxes and withholding you need to adjust. We have spoken about that. So here's an example of a company. There's an Indian company who contacted me and said, okay, they have had a contract in the US for $1 million to do business here, and they do some events in the US. So the profit margin was only 10%. But the problem was when the US person pays this company, the US company, they have to withhold 30%. So 300,000 of this was withheld. And so it was a real problem. So what we did is we structured it differently. We set up an S corp, and I'll give you the solution in 1 minute. But there were choices. C corp, you have double tax, but you can carry losses back and forth. S corp, you're not eligible if you're not a resident of the United States, and that person was not a resident. Limited liability corporation, it's limited for legal purposes, but partnership for tax purposes. So then you have partnership, and finally you have sole proprietor. So none of these choices were really applicable here. It was torn between a C and an LLC and a partnership. So those are the three practical solutions. This one also possible, but a little more complex, S corp, because if he got sued, then all his assets were at stake. So we advise the client to do an LLC, so the benefits of limited liability, but he files a partnership return 1065 is the best of both worlds, resulting in no tax at the corporate. So there's no 30% withholding, and they only pay tax at the federal level, and there's no double taxation, in other words. Incorporated and no non-taxing state, then only federal taxes. Example, if you have this company set up in Florida, then there's no state tax also. Slide 36, we talk about global positioning. You want to understand your global assets and liabilities. That way you become smarter. And then finally, any income expenses relate to that. So sometimes you can tie the tax return to this and you know that you're dealing with everything. As you've noticed, a lot of foreign people buying US real estate, and you buy real estate in New York and other favorable places. LLC is suitable. You can buy the real estate in the name of the company. You need a global footprint. Who can use as an office? That becomes an issue. Permanent establishment and would create US taxes. So that's one issue. And some companies want to show their presence in the US. But if you sell this real estate, then there's a 10% withholding on the gross amount of any US real estate if you're a non-resident. So let's say a Chinese person comes to the US and buys real estate for 100,000 and sells it for 200,000, then they have to withhold 20,000 on that transaction and send it to the government. Okay, that's just if you're a non-resident, 20% of that amount of the gross amount of sale, rather 10% of the gross amount in this case of 200,000 would be $20,000 would have to be sent to the government. High-level differences. This will be our last few slides, and then I'll take questions as they become appropriate. Okay, fiscal year in the US, we have a calendar year. In India, you have 4/1 to 3/31. Next one is capital gains. You have 3 years is considered capital gains. In the US, only 1 year. You can invest in rural bonds. There's no such option in the US. Dividends are not taxed in India, but they are taxed in the US. So let's say Indian companies pay you tax. The US government will still charge you tax in that. They don't care whether India taxed it or not. Being a US citizen or resident, you will pay tax on Indian dividends. Real estate, you got a 30% deduction and no depreciation in India. So they just give you a 30% allowance. They tell you we don't need to know your itemized expenses. In the US, you would file a form called Schedule E, but it'll have to itemize all the income and expenses. And then you have a depreciation, which is about 40 years because it's foreign real estate. So that's how this would work. So I just wanted to give you a quick flavor, a high level, but I want to re-emphasize before I take any questions. This area of law is very complex. You're basically going through 2 tax laws. I'll give you my contact information, and I know Mark, we're happy to take any questions, comments, suggestions. So either on the chat box, or if you want to just say whatever questions come in, I'll be happy to take it. I'll leave the contact information up here. Mark, are you there?
Cecil, I'm here. Can you hear me?
Yes, I can.
Okay, I was on mute. I'm waiting for questions. I don't think we have questions so far. So if you have any questions, please submit them at the chat window.
Did it all come through clear, Mark?
Yes.
Okay.
And also it's recorded. Some people may be
Okay.
able to watch later. And sorry about the technical difficulties.
No problem.
I think what we should do is going forward, maybe we ourselves probably try this a couple of times and make sure it works, right, with multiple things. So because it's been a while because we didn't do this for the last 3 months because of summer. So maybe we need to write down the instructions again. And then since we are starting for next 9 months, it's better to write down and then go through this couple of trial runs internally here with the tech team. So we'll do that. Sorry about any difficulties.
You have the presentation. Our contact information is here. So what we do is, Mark, I'll wait another couple of minutes if you feel any other questions. But I think I want to just mention two, three things. The area of tax law is very complex, but I specialize in international tax and international accounting. So I tell everyone, get the right answer because down the road it will only help you. Don't just go with any answer that only makes it worse. So we are happy to help. We've helped hundreds of clients, and we are a big firm, so we are all three CPAs. And we specialize in different areas. So. But we'll be happy to answer any questions in the next couple of minutes. If not, you have the slides. But one more comment, these slides are all proprietary, and so they cannot be disseminated other than your audience, right, Mark? So please make sure that, because I write content for different other providers also, and so we have to respect that copyright issue.
Okay, I have not sent the slides to anybody. If somebody asks only, we'll send it to them.
Yes.
Okay, this is not publicly distributed.
Correct.
Last time we gave,
Correct.
a couple of people asked, we only sent it to them.
Yes.
What we can do is, since we have the contact information, people can watch this slide. I would request all of you to contact directly this Cecil Nazareth. The numbers are there, the email is there. The numbers is there, you can contact him directly. And if you have any questions, you can ask him directly as well. So since we do not have any questions, I think we can end this session here, Cecil.
Yes, thank you very much.
Right, and thank you very much for being with us and providing this instruction. Those who are in the fore and listening, this is our Empower Me series. We do this once in a month, fourth Sunday of the month at 8:30. We took a 3 months break during summer because of the other activities like coding classes, painting, and other things. We're starting this again this month with the international tax. Next month we have a topic on health where the homeopathy medicine, how it can be a combined medicine. We'll see you again next month, October, fourth Sunday, same time, 8:30 on the fourth Sunday of the month. Thank you again, and if there are any questions, please note down this number. And this video link is available in the YouTube. If you can go to MCA-EC or YouTube and just say MCA-EC or Cecil Nazareth, it should be available to you. Thank you and goodbye.
Thank you very much.
Bye-bye.
And have a great day. Great evening.